How to handle income tax notices. Hi everyone, I'm Ushma Jain. Welcome back to my channel. Wishing you a productive and rewarding day. Today I'm going to talk about a topic that creates a lot of fear and confusion. That is income tax notices. If you have received one, there is no need to panic because it can be resolved without any tax demand if addressed correctly. In this video, I'll explain why people get notices, how to avoid them, and most importantly, how to handle them smartly and smoothly. Why you get an income tax notice? Getting a notice doesn't mean you have done something wrong. It simply means that department needs some clarification. Here are most common reasons. Mismatch in reported income. If your ITR doesn't match Form 26AS or AIS, especially TDS or interest income, that can trigger a notice. Non filing of ITR. If you had high value transactions or TDS deducted but didn't file a return, you could get a notice under Section 142, subsection 1 or Section 148. High value transactions. Buying a property, investing in securities, or transferring large sums between accounts without explaining the source can raise red flags. Huge cash deposits or gifts. Depositing large cash amounts or receiving a big gift without proper declaration can draw attention. Repatriation of funds. Repatriation of funds abroad without filing ITR, especially in case of NRIs. This can also be a reason for getting a notice. Errors or omissions in ITR, like wrong PAN, skipping income details, or claiming incorrect deductions. Random selection or AI based scrutiny. Some cases are flagged automatically by the IT system for review. Now, next question is how to avoid getting such notices. Most notices can be avoided if you are careful and compliant. Here's what you can do. Make it a habit to file your ITR regularly, even if your income is below the exemption limit. Don't assume it's okay to skip filing. Filing your ITR regularly helps establish your residential status and shows your intent to remain compliant with tax laws. Make sure to report exempt income such as NRE interest, gifts, or inheritance under the exempt income section. It might seem unimportant, but doing so is crucial. It can prevent future notices or make it easier to respond if any queries arise later. Choose the correct ITR form. Using the wrong ITR form can result in defective returns or trigger unnecessary notices. For instance, I have seen many NRIs filing ITR 1, which is meant only for certain residents. As a result, the department starts asking for details of their foreign income since global income is taxable for residents. Disclose all significant transactions openly and honestly. For instance, if you have received a gift or inheritance, make sure to report it correctly. For residents holding foreign assets or earning foreign income, ensure these are declared under the appropriate schedules of your ITR. Transparency helps avoid complications later. Always cross check your Form 26AS and AIS before filing your return to ensure all reported income and TDS details match. You might find income entries there that you were unaware of or may have accidentally missed while reporting. Avoid indirect ways to save tax. I have seen NRIs attempt to give property to resident relatives, hoping the sale will then fall under resident tax provisions. These kind of indirect methods often raise red flags eventually. When they do, the consequences can be far more serious. It's best to stay compliant and follow the correct legal route. Another common example is spreading cash deposits across multiple bank accounts, assuming one bank won't report it. But remember, all your accounts are linked to the same PAN. Eventually, the transactions get flagged and your case may come under scrutiny. I can share many examples like that. But the reality is, things have changed in India. With increased digitization, almost every transaction is linked to your PAN, whether it's through banks, brokers, tax deductors, employers, sub registrars, or any other third party. Your financial activities are reported to the income tax department from multiple sources. Consult a professional. I have come across many cases where individuals file their tax returns on their own, thinking it's very simple. But they often end up using the wrong ITR forms or missing out on key schedules or forgetting to report exempt income. While the return may get processed initially, these mistakes can lead to red flags and notices years later. So it's always wiser to seek professional help right from the start. Now, most important part is how to handle a tax notice. First thing first, update income tax login profile. Ensure your communication details in the profile are updated to avoid missing any important notice from the department and to respond promptly. Also, check the e proceedings or pending actions tab to see if any notices have already been issued. Read the notice carefully. Understand this section. Is it section 143 subsection 1 or 142 subsection 1 or 148 or 139 subsection 9 or 156 or any other section? Each type requires a different response. Check the response deadline. Always act within the time limit. Delaying can lead to penalties or even best judgment assessments. Keep documents ready and organized. Download all relevant bank statements, investment proofs, and property documents. Save them in a folder for easy access. Keep your response simple and to the point. Avoid using complex or technical language. In the current faceless regime, our main goal is to keep the assessing officer clearly understand our case. If we make it too complicated, it becomes difficult for them to follow. The days of using heavy legal jargon are over. Also, make sure to clearly mention annexures, page numbers, tables, etc. So everything is easy to refer and understand. Also, your reply should be factual and supported by documents. Don't assume the officer will understand your intent. Please note only evidence counts. Check the assessment year mentioned in the notice carefully. All documents you submit should support the figures related to that specific year. Any details of proof after the relevant assessment year will not be considered and are of no use. Using the adjournment option if needed. If you are unable to gather documents in time, ask for an extension. But be alert, the adjournment window stays open only for a short period. Keep all communications saved. Download every reply, acknowledgements, notices, copy for your records. Personal hearing. If the assessing officer has offered an opportunity for a personal meeting, make sure to take it. Meeting in person can help clarify your case more effectively and may expedite the resolution process. Seek professional help, especially for complex or reassessment cases. A tax expert can help you respond strategically and avoid further issues. And most importantly, have patience. The department typically takes considerable time to respond, which is a normal part of the process. It's important to remain patient and stay vigilant about any notices received. Once involved, resolution can take years. Limitation period. So this is very important and interesting. Every proceedings is bound by a statutory time limit within which the assessing officer must complete the assessment. Typically, AOs become more active as the limitation period approaches, and may seek prompt responses. Therefore, it is advisable to keep all the relevant documents prepared in advance to avoid last minute pressure. File an appeal. If you have received an order that you believe is unjust and not in your favor, don't lose hope. It's not the end of the road. You have the right to challenge the decision by filing an appeal with the Commissioner of Appeals within 30 days from the date of receiving the order. Now, let me explain you it with a real time example we handled recently. An NRI received a notice simply because he purchased a house in India using inward remittance, but did not file an ITR in the year of purchase, as his Indian income was below the exemption limit. Now, the notice was triggered because his income in India didn't appear sufficient to justify the property purchase. At first glance, the case may seem straightforward, but it can quickly become complicated if not handled carefully. If the source of funds is not clearly explained, the assessing officer AO may treat the entire purchase amount as unexplained income. This could lead to a huge tax demand along with interest under section 234A for default in filing return and section 234B for default in advance tax payments, late filing fee under section 234F, and even penalty proceedings for underreporting or misreporting income, which can be up to 50% of the tax amount. The total liability can run into crores. So that's why such matters must be handled seriously and without delay. He approached us to handle his case. We advised the client to provide proper NRI proofs, including passport with entry exit details, OCI card, utility bill, foreign ITRs, employment proofs from abroad, bank statements showing the funds flow, and all documents related to property. We then drafted a detailed and easy to understand reply, clearly explaining the flow of every rupee from foreign income to the Indian bank account and then to the builder. And we also filed the ITR under section 148. During the process, the AO repeated many of his questions, which we patiently answered every time, backing each response with logical explanations and proper documentation. And finally, we received the assessment order with nil demand. This proves that when a notice is handled properly, the case can be closed with no tax demand. So, this video aims to reassure that an income tax notice isn't as intimidating as it may seem. With the right approach and careful handling, you can resolve it. If you need any assistance with taxes in India, feel free to reach out. See you in next video. Take care and bye.